Hi everyone, welcome to Sia Home Realty. Today we invited our guest speaker, Christian, to be on the video, and he is going to talk about all the most important loan programs for our buyers. What options do you have? He is a very reputable loan officer, been in the business for 30 years. First, very important question. Can you tell us about FHA loan and the lowest down payment required for this type of loan?
Excellent. Yes, thank you for having me. With FHA, they actually allow you to put down as little as 3.5%. But we're really excited about FHA these days because they just lowered the MIP, the mortgage insurance premium. It used to be 0.85%. Now it's 0.55%. In Orange County, for our buyers, that makes a difference. That's like $200 a month on average savings, if not more, because the loan amounts are a lot higher here. So FHA has become a very affordable option now because the rates are typically lower than conventional, and the mortgage insurance is now only 0.55%. So that's a really exciting option. There's also VA, which is the lowest down payment option that you could possibly have, but you have to be a veteran. You have to have served in the military for the US. But that's one of the best loan programs out there for home buyers, and especially first-time home buyers, because they can put 0% down and there's no mortgage insurance.
Wow.
With all VA loans, there's no mortgage insurance. And then we also have conventional. That's another popular program. You only actually have to put 3% down. A lot of people think that you have to put down 5, 10, 15%, 20% down with conventional. They actually have 3% down options in Orange County up to a $726,000 loan amount. So that's another low down payment assistance option.
Oh, that's perfect. So for the conventional loan, I think it's the most popular, right? And who will qualify for this? Like only requires 3%, a $1 million home, only $30,000, right?
Yes, $1 million home, only 3.5% down. We actually have a loan originator in our office that's using FHA to buy $1 million home now. Why? Because low down payment, lower mortgage insurance nowadays, and the numbers are penciling out where it actually makes sense to go with an FHA option. Who qualifies? They actually allow you to carry a little bit higher debt to income ratios. So looking at your income compared to your auto expenses and credit cards, FHA actually makes it a little bit easier to qualify for those lower down payment options as well. So that's another reason why FHA is a great option.
So I've been in the business for many years. Usually it's like 50% loan to value. And for FHA, is that a little higher?
Yeah, FHA, the loan to value is as high as 96.5%.
Wow, so you make $100, you can spend $99 something towards all the credit payment.
Correct. The purchasing power is pretty strong,
I see.
Now, obviously, do we recommend a buyer gets in over their head? No, we'll always disclose what the monthly payment's going to be upfront while they're getting pre-approved. These are your options. This is the monthly payments, so that we can kind of work backwards too to say, well, we want to stay for our budget around this monthly payment, and that's where we feel comfortable.
So Christian, what if the client didn't report a lot of tax and they still wanted to have a mortgage by a house? I think you offer something called non-QM, right?
Yes, yeah. So non-QM is called a non-qualified mortgage. So conventional, FHA, VA, they all fall into the qualified mortgage category. So a non-QM loan is those alternative documentation type loans, right? For our self-employed individuals, we have a 12-month bank statement loan, 12 to 24 months. Sometimes showing 24 months actually helps you get a better rate. So you can show 12 months bank statements, let's say, and then we average those deposits over the past 12 months. And then we take out a little bit of an expense factor for their business, and then we use that as their income. Why is that important? Well, obviously all self-employed borrowers, all self-employed people in general, want to file as little taxes as possible, right? Show as little income as possible.
Yeah.
Totally understandable. That's what you have at your disposal. I get it. But the downside is qualifying. So that's why non-QM loans are a great option for self-employed individuals, especially because they have those alternative documentation options, right? Where they can use 12 months of bank statements and things like that. During this time of the year, it is good to mention that conventional loans are still an option for self-employed individuals if they want to consult with us, and we can advise them on how much income they actually need to be showing to be able to qualify for a conventional loan. Why is that important? Conventional loans typically are going to have better interest rates than a 12-month bank statement alternative documentation, because those loans are a little bit more risky.
Yeah.
So as a result, higher interest rates. So if you want to fit into that conventional loan, conventional box right now, it is a good time for them to consider filing maybe a little bit more income on their taxes this year while they're looking to purchase a home. And we can tell them when we get a copy of their draft, this is how much income we're calculating, and this is how much you'll qualify for. If you show a little bit more income, you'll qualify for a little bit more.
Yeah, so self-employed buyers, be aware if you haven't filed your tax yet, but you want to buy a house this year, please talk to Christian first, and then try to extend your tax reporting as late as possible, so you still have time to qualify for the lower interest rate program.
Correct.
Right? The next question I heard about, there's some type of families, like their son or daughter want to buy a house, their family is super rich, but they don't really have a job. They don't make anything. Can they still buy a house under their name?
Yeah, this is a really interesting conventional guideline that we've seen, because basically it's just trust income, right? Think about your average, they call it trust fund baby, right? So any person out there can set up a trust, fund the trust, meaning put money into a checking account, savings account, and have those funds set aside for the trust, and basically take a distribution from that trust and use it as income. Why is that important? Again, because now someone that has a lot of assets, right? So let's say they have $1 million in the bank. Can they afford to make a $500,000 mortgage? Yeah, they can afford to pay it off in full twice. So we really look at that, and then we help them structure their income, that $1 million in assets, so that they can qualify for a home that they want to purchase using trust income.
So do they still need to have the trust already and with a lot of money in the trust, or any like proof for their parents to owning a lot of asset in order to qualify for this loan?
That's a good question. If they already have a trust set up through their family, great. And their family can show that they're going to set up a distribution of income to them, great. If they don't have a trust set up already, we can help them set up a trust through our trust attorneys that we work with, and basically help them set up that distribution.
And they don't have to prove that there's any money in the trust yet, right?
They'll have to transfer the funds into the trust, but they don't have to have a history of receiving that distribution. So they will have to have the trust funded, but they won't have to have a history of the distribution. And the trust income just has to be able to continue for 3 years.
Oh, so they don't have to transfer $1 million there. They just transfer like 3.
So let's say they want to
years?
use $10,000 a month of income. They have to have about $360,000 in that trust, because then it can continue for 3 years.
Gotcha. Very, very easy and clear. This loan program, even if your parents don't make a lot of money, but as long as you put up a trust and have 3 months, right?
And have the assets, 3 years.
3 years.
Yes.
3 years asset, then you can qualify for a loan. Let's talk about people who are at the senior age. Like, what if they are like a doctor's nurse, but they are 50 years old and they put a lot of money into their retirement account? Does that retirement money can be used to qualify for the qualified loan program?
That's a good question too. If you're of retirement age, so 59 and a half or older, and you have a retirement account, let's say you're self-employed, you don't show a lot of income, or let's say you just have your Social Security income only at this point. So you only make $2,000 a month in Social Security income. That's all you have to show and report. But you have $500,000, $600,000 in your IRA or in your 401k. Yes, same thing as the trust, similar concept. You can take a distribution from that retirement account if you're of retirement age and use that as income to supplement the documented income and qualify for a mortgage that, again, most importantly, at the end of the day, can you afford the mortgage payment? Yes, you have $600,000 in the bank. You could afford to pay off the mortgage in full. But to structure the income, that's where we really come in and help advise how to set up your assets, set up your financial picture to qualify for the mortgage.
Yes. Thank you, Christian. Thank you for this valuable information. And again, if you want to buy a house, please contact us. We are working as a team, provide you a home showing or home selling service. Plus, we have Christian help you to structure your loan to help you get the best rates and the lowest amount of down payment available. And his program covers all type of people. So please contact us and see you next video.
Thank you.